Hello and welcome to this panel on European regulatory framework for market infrastructure. My name is Kostas Moussalas and I'm a journalist with Risk Magazine, and I'll be the moderator for this panel to steer the discussion on EU regulation in this area, to discuss various topics and get into the details. But before we talk about that, I would like to ask my fantastic panelists to introduce themselves and what they do.
Thank you, Kostas, and thank you everyone for joining. My name is Elena Tonetto, and I work as Senior Policy Advisor at the European Association of CCP Clearinghouses. We are Brussels-based, and we have 19 members. So we have 13 members based in the EU, then we have 3 in the UK, and then we have other members in Switzerland, Russia, and Turkey.
Good afternoon all. My name is Sebastian van Kempenhout. I'm working for Euroclear. Euroclear, for the ones who do not know, is a group of CSDs. It's the largest in Europe, and it includes the CSDs of France, Belgium, the Netherlands, Finland, Sweden, and the UK, as well as the international CSD, Euroclear Bank. I'm a public policy officer for Euroclear, and I've been working in the company for more than 10 years.
And good afternoon, everybody. My name is Laurent Collet. I'm a partner with Deloitte Consulting, based in Luxembourg, and in charge of strategy in line with market infrastructure on the trade and the post-trade aspect. 25 years of experience in the industry, starting in Brussels with Euroclear, and afterwards joining the consulting world. And take this opportunity also to thank you, the Arab Federation of Exchange, for inviting me to this interesting panel.
Fantastic, thank you. And before we begin, I just want to remind audience members that we will definitely be taking questions. So if you have any questions, please pop them through. I'll read them and direct them to the appropriate panelists, or even ask the whole panel if appropriate, and we'll get an answer to that question. So without further ado, we're going to talk a little bit about the huge amount of reform that has occurred over the past decade after the financial crisis in Europe, and specifically about the different regulations that govern market infrastructure. So we saw, for example, the introduction of EMIR, which reformed derivatives markets and clearing, MIFIR and MIFID II, which is focused on transparency in trading venues, CSDR, for securities depositories and transparency and efficiency there, and T2S, so the settlement engine. And all this has radically overhauled the framework. And there's been a lot to balance here between member state interests, between different regulators, different interests, and it's all in the name of, a capital markets union, sort of standards, etc. So maybe we could start at the beginning here. And Laurent, maybe you can tell us a little bit about sort of the financial crisis in 2008, how it sort of impacted things in Europe, and sort of focused minds on unifying and upgrading this framework for the markets.
Yeah, sure, Costa. And I will not go into each and every detail of this 2008 crisis, because otherwise we will spend the whole afternoon on the topic. But let me just remind the fact that this crisis was also called a global financial crisis. So it was not only a EU crisis, it was clearly a global one. And this is why we have seen in 2009 that the G20, which is the representative of the main governments in the world, sit together and decide to take some measure in order to address the root causes of this crisis. Those measures are quite, I would say, easy to summarize, even if there are quite a lot of measures. But I mean, the main objective was to, first of all, address the risks that we have seen in 2008 around the financial institution and the bankruptcy that we have seen. Assess the risk, enhance the transparency also on all the financial market, and more particularly in the transaction that were basically set between participants with new reporting, and as well to protect more than ever the investor. So those basically main objectives were translated in all the regulation that you have named. And from an EU point of view, European point of view, we have seen EMIR, we have seen MIFIR, we have seen CSDR, we have seen market abuse regulation. So all those regulations basically have the equivalent in other jurisdictions in the world, like we see in US and in Asia. What was basically specific to Europe is that, as you know, Europe is a collection of a lot of different countries. So the main challenge was basically to set up a common framework, a common regulatory framework for all the countries in Europe. Not easy, because there are different marketplace, different interests, different culture that you need to reconcile. And I mean, one of the key elements that we have seen in Europe to tackle this aspect was the organization of what we call regulation, which is the way for Europe to set up a set of framework which should be applied the same way everywhere in Europe. So you have the directive like MIFID. MIFID is a directive that you can translate into national law, but with some difference from the French to the German, for example. And then you have the regulation which apply the same way everywhere in Europe. And this is basically, I mean, what was, I think, one of the key elements that we have seen in Europe in line of the 2008 crisis. And this framework is basically, we have seen quite a tsunami in the first years with a set of all these new directives and regulation. But right now the process is still going on for the sake of the market infrastructure in Europe.
Interesting, thanks, Laurent. And yeah, I mean, very big changes over the past decade, and as you say, I mean, different jurisdictions have tackled it in different ways, and there hasn't always been entirely cohesiveness between jurisdictions. You know, with the PFMIs, there have been some varying interpretations, and also we saw, for example, more recently, an example of European Union, at least with EMIR, sort of setting standards for the rest of the world. So the margin procyclicality measures within EMIR were sort of, despite the fact that they're not mirrored so much in the US, all the US CCPs sort of hold themselves to those standards as well, just so they can service EU customers. And we see sort of similar things with the US a few years ago with the CFTC. So definitely there can be some interlapping between jurisdictions, perhaps not the exact same interpretation of the rules or different implementation that does overlap. But with that in mind, Elena, I did want to ask a little bit about EMIR and sort of start going over these regulations, how it reforms standards for clearinghouses, market participants, and derivatives markets in Europe.
Thank you, Kostas. Yeah, I can echo a bit what Laurent just mentioned about the fact that after the crisis, the big challenge was indeed to create a sort of a common framework. And I can say that EMIR responds to this kind of challenge. It entered into force in August in 2012, and its history, let's say, indeed dates back to the crisis time, and in particular to the G20, that took place in Pittsburgh in 2009. And during that big important event, the participants committed to, for instance, reduce the systemic counterparty and operational risk and increase some transparency in the OTC derivative market. And this is exactly the purpose of EMIR, the purpose that it wants to fulfill. So to ensure financial stability and prevent the collapse that followed the Lehman Brothers collapse in 2008. And in this context, I can say that it's important to keep in mind that at the time, Lehman had exposures that went through the CCP and other exposures that did not go through a CCP and remained bilateral. And those who went through a CCP were then closed, like in a couple of weeks, while those who remained bilateral remained open for several years. So this really shows the importance of the clearing worlds to maintain financial stability. And what EMIR does is to establish common rules for both CCPs and also trade repositories, and cover all the entities that qualify for derivative contracts in regards to like interest rates, equity, foreign exchange, and also commodity credit derivatives. And we could talk long hours about EMIR, but I just would like to underline a few the more important aspect of this legislation. So the fact that it includes 3 sets of obligations. So the first one is the reporting obligation, the clearing obligation, and then the obligation of applying risk mitigation of applicable products. Regarding the reporting obligation, well, EMIR requires reporting of the transaction details of both type of derivatives, so both the exchange traded and the OTC derivatives to trade repository. And under the clearing obligation, EMIR includes indeed the mandatory obligation to centrally clear certain classes of over-the-counter OTC derivative contracts for CCP. And some of the asset classes could be basis swap, fixed to float, interest rate swap, forward rate agreements, just to give you a little bit of an example. And in this context, there are 2 main categories of counterparties that have to are subject to the clearing obligation, depending on whether their positions are above or below what is called the clearing threshold. So these categories are financial counterparties, so banks, insurers, asset managers, etc., and also non-financial counterparties. So those firms that take positions in OTC derivatives that are not financial counterparties. And lastly, I mentioned before the risk mitigation techniques, and they must be applied for OTC derivative contracts that are not centrally cleared. So also those who are not centrally cleared still must be performed in a way that financial stability is maintained. So those financial counterparties that enters into OTC derivative contracts that are not cleared are still required to ensure the appropriate procedures and arrangements to measure, monitor, and mitigate the operational risk and the counterparty risk. So we could say portfolio reconciliation, portfolio compression, etc. And also an important thing to mention is that EMIR puts in place for CCPs quite stringent rules that must be respected concerning the organizational structure, the conduct of business, and it also imposes very strict prudential requirements. For instance, CCPs are forced to ensure adequate assessment of liquidity and credit exposure to each clearing member. Then CCPs must have continuous access to adequate liquidity, provide robust risk management. So all this is foreseen in EMIR. And a last point that I can make is that EMIR was developed at the same time of the PFMI's principles, and they are very well reflected into EMIR. Actually, also EMIR goes a bit beyond, but perhaps we could mention this later.
Really interesting. So yeah, we saw after the implementation of EMIR, huge shift in the clearing mandate to
So I see that Costas has lost the connection. So maybe, well, because Laurent started discussing about MIFID, Elena just started discussing about EMIR. Maybe I can say a few words about CSDR. In the meantime, he's back. I see Costas, you're back. Maybe not. No, I will already discuss a bit on CSDR then. So CSDR is the European regulation that is addressing the CSDs. So it's a very small summary for the European Union. When you're talking about the trading and the post-trading markets, you have MIFID and MIFIR, which mainly applies to the trading venues. You have EMIR, which applies to the clearing houses, the CCPs, and you have CSDR that applies to the CSDs. So CSDR has been put into force in 2014 in Europe and is derived from the PFMIs that were drafted by CPMI IOSCO in 2012. So it's very similar to what Elena explained about EMIR. So because both CCPs and CSDs are considered as financial market infrastructures, and therefore there are principles that have been drafted at global level and that are addressing these specific financial market infrastructures that are considered as systemic. And so these principles drafted in 2012 are principles. So this means that by definition, they are not law, they are not required to be followed. So that's why they need to be transposed at regional and national level. The EU did that with EMIR for CCPs and CSDR for CSDs. So these requirements, these principles that were put into law are mainly addressing the financial stability and systemic risks that are that face the markets due to the systemic importance of these entities of CSDs and CCPs. So CSDR includes very stringent requirements that are due to the liquidity requirements. Typical example is that a CSD that does not have a banking license can only use central bank money when it performs settlements. Roughly, we cannot take any sort of credit risk. So the requirements for CSDs, as for other financial market infrastructures, are extremely stringent due to the PFMIs. What is particular about CSDR is that, and that's I suppose the same for EMIR, is that the EU took the opportunity of CSDR to include other requirements that are not only linked to financial stability and systemic risk, but the EU authorities also wanted to foster competition and increase harmonization in the EU. And so they took the opportunity of CSDR to create this competitive dynamic in the CSD layer that was not there prior CSDR. To understand how this is the case, it's rather easy. Prior CSDR, all the CSDs were regulated nationally. So it was national regulation that were saying how CSDs must behave and what are their requirements. So obviously when you have 20, well, back then it was 28 member states, I would expect. So when you have 28 different legislation that explains how a CSD must act, you can imagine that there was quite some differences in terms of requirements. There was no real level playing fields. The procedures of settlements were different in all different countries. So the EU took the opportunity of CSDR to harmonize all this by creating one single rule book for all CSDs across the EU. So in 2014, they put in place CSDR, and one of the requirements was, the key requirement was to get a CSDR license, to be licensed under CSDR. So all the European CSDs were under quite a lot of, well, it was quite a journey for all of us to obtain this license because it was new requirements and most of us took many years to get it. Euroclear, we got all our license, I believe 1 or 2 years ago now, last year, I believe. But still some CSDs in Europe don't have their license, their CSDR license. So that's just to tell you how strict and how stringent the requirements from CSDR are and how it was very a journey for the CSDs to implement them. But in the end, even though it was complicated to do it, it's all for the good cause because as Laurent and Elena mentioned, most of these new regulations that came in the aftermath of the financial crisis are aiming to increase financial stability and avoid systemic risk. So definitely FMIs now are safer than we've ever been. So that was a short comment about CSDR. I suppose that's something that you wanted to discuss, Kostas?
Yes, of course. Thank you, Sebastian, for explaining that. And in the context of CSDR, could you also quickly give us an overview of T2S and sort of how that fits in with the broader framework and what the goal is there for European authorities?
Yes, sure. Well, CSDR and T2S are completely different from one to the other because one is a regulation and T2S is a platform. So it's a settlement platform that was developed by the ECB, the European Central Bank. And even though they are very different from one to the other, they are both aiming for the same objectives. I mentioned that the objective of CSDR was to increase financial stability and avoid systemic risk. That's one. And the other is to foster competition, increase harmonization, and put in place a level playing field between the CSDs. That's exactly what T2S aims to do as well. So T2S is a settlement platform that was put in place by the European Central Bank, on which the CSDs are connected. So today, I believe there are 21 CSDs connected to it, coming from 20 different European countries. And these CSDs are performing the settlement of the securities, so exchanging the cash with the securities on this T2S platform. So the DVP settlement in central bank money is taking place there. Obviously, the financial stability objective is reached because, well, settlement is taking place in central bank money. It's obviously a very resilient and very powerful platform that was developed by the ECB. And the ECB oversees it. So financial stability is obviously there. In terms of level playing field and competition, it's exactly the same principle as I mentioned before with the CSDs that were beforehand regulated nationally. Well, all of them had different procedures and rules for the settlement of securities. There, with T2S, all the settlement procedures and rules for each domestic CSD that is connected to T2S is exactly the same. So there now we have a harmonized way of performing settlements and DVP settlements in the EU for all the domestic CSDs that are connected. And that obviously facilitates a lot the cross-border settlements between the different CSDs, between the different countries. And let's not forget that indeed the European Union is a union and it aims to foster and to dynamize the cross-border transaction between the different countries. And that's one of the key elements of T2S. And so far, it's still being, so this T2S has been there for quite a few years, but they are still working on it. They are aiming in the next few years to consolidate with the T2 platform. So T2 is the payments platform. So the ECB is still continuing to work on this to make it even more powerful and a better harmonization tool.
Really interesting, Sebastian. And what was also quite interesting to see was just over a year ago, a lot of the repo clearing that took place in London moved to the European Union, in part because of this pull factor from T2S and taking advantage of this unified settlement engine. So definitely some big changes that we saw there as a result of that. Indeed,
so indeed, just a very good point. T2S allows one very big feature is the possibility for participants to pool their collateral on T2S, which was obviously not possible before when all the CSDs were just individual settlement platforms. So in the past, you had, as a client, you had to move your collateral here and there. Now you can have everything on T2S, so it facilitates a lot the settlement activity of clients. Yes.
Right. Yeah. So definitely an example of unifying standards, pooling liquidity, getting netting and interoperability, maximizing talking between institutions. So Laurent, maybe just quickly to cap off this introduction to these regulations which make up the sort of patchwork for market infrastructure. Maybe you could give us an overview of MIFID or of MIFIR, MIFID 2/MIFID 2, and talk about the transparency and how it reforms sort of trading there and transparency. Yeah.
it will be better unmuted. Sure, Costas. In fact, Elena addressed the CCP in the derivative world. Sebastian addressed the post-trading aspect. So the last piece of information to be regulated was essentially the trading aspect. And this is one of the key focus on MIFID. MIFID journey started in 2004, by the way, quite a long time ago with MIFID 1, where the idea was to protect the investor, the retail investor going to the market in terms of transparency, in terms also of governing the role of the investment firms, providing those services to the investor, as well as the market infrastructure platforms. Then we, after the entry in force of MIFID 1 and quickly after the crisis, the authorities decided to go much more into the detail of those regulations with MIFID 2, which keep on going to focus on the protection of the investor, providing the best execution in terms of transaction, to guarantee the investor to have the best price possible, to have the full transparency in terms of the information related to the cost of the transaction. But I would say that one of the main transformation that we have seen with MIFID 2 and MIFIR was essentially this MIFIR bit of information. As I say, MIFID was a directive, so they can be transposed differently from one country to the other one with different interpretation. And the authorities decided with MIFIR to say, well, for MIFIR, and MIFIR is basically about the, I would say, all the reporting of the transaction. I speak about the transparency that the authority wanted to put on the market, and MIFIR addressed specifically the reporting of the trade as well as the transaction which are organized in Europe by all the counterparties. And in order to avoid also the fact that there are different interpretations between the country, they have decided to put all these requirements under a common regulation, MIFIR. And because obviously market is cross-border in Europe, so we should have the same reporting requirement within Europe. Also interesting to highlight today is that when we look to the European landscape in terms of transaction, today when you report or you do a transaction, whatever the instrument, if it is a derivative instrument, if it is a listed instrument, which is all about MIFID, or even a securities lending and borrowing instrument, you have to report this transaction within 24 hours to dedicated authorities, between being either national competent authorities in the case of MIFIR or a trade repository. So I would say that we came to a point right now in Europe that in terms of the transparency of the transaction, we have high, basically, pressure in terms for the financial institution to report all those transactions on a 24-hour basis.
Really interesting. So the common theme we see here is lots more transparency across these regulations, a lot more reporting, and trying to sort of unify standards across the member states, make sure that there's a level playing field there, and trying to reform the market so you don't have another 2008, basically. But then we also see that the European process can and does lead to reform of these regulations fairly quickly. I think we saw that MIFID and then MIFID 2. But more recently, we also saw quite big changes to EMIR. We saw EMIR 2, we saw the refit of EMIR changing the relationships between NCAs, so the national competent authorities of individual member states, and the pan-European regulator ESMA. We saw differences to the way clearinghouses are supervised. Maybe Elena, you could give us a quick overview of those changes that we saw and how that sort of works in the European context with the built-in review mechanism, and how that process can work.
Sure, thank you, Kostas. So just perhaps for those who are a little bit less familiar with the EU legislative process, I can give just a little bit of an overview. So basically the EU legislative process is composed of two parts. So we have the level 1 that produces the framework legislation that is, and the actors in this process are the European Commission, the Council of the European Union, and the European Parliament. Then we have a level 2, and that produces the technical legislations, and this is dealt with by the European authorities. And in the case of CCPs, usually this is the European Securities and Markets Authority, so ESMA. And basically in level 1, the Commission, the Council, and the Parliament produces the set of framework legislation, which includes certain provisions that are usually the more technical, that are then mandated to be dealt with in the level 2 by the authorities, because otherwise, for the 3 institutions agreeing on every single technical detail, I believe it would make the process really endless. So we have these 2 stages, and the financial regulations are basically reviewed as all the other European legislation. So the level 1 includes usually includes provisions that are mandated to be reviewed after a few years. It could be 3 years, 4 years, or even longer, because the society, the economic environment, and financial markets change. So also the provisions in the legislation must adapt a little bit to the new changes. And regarding EMIR, as I said before, this entered into force in 2012. And it was recently reviewed, and it gave birth, let's say, to 2 different legislations. So one is called the EMIR refit, and the other one is called EMIR 2.2. Also, maybe sometimes you heard it called EMIR supervision. So the first one, the EMIR refit, contains revised provisions concerning very, let's say, technical topics. So the reporting obligations, the clearing thresholds, the possibility of finding central clearing solutions for the pension schemes arrangements. It also deals with the post-trade risk reduction services, and whether trades that directly result from a post-trade risk reduction service, including, for instance, portfolio compression, should be exempted or not from the clearing obligations. So these are just some of the provisions that have been dealt with in EMIR refit, and most of them then have been mandated to be dealt with by ESMA in level 2 with guidelines or regulatory technical standards. The second one, EMIR 2.2 or EMIR supervision, instead concerns the procedures for authorization of CCPs, and also requirements for the recognition of third country CCPs. And so this legislation basically charges ESMA with the task of recognizing third country CCPs. It also confers to it the power of supervising the systemically important third country CCPs, and also allows for the creation of a specific committee within ESMA, the ESMA CCP Supervisory Committee, to indeed supervise all this process, the supervision tasks, and this committee is actually currently in place and very active. So this is just a bit of an overview of how EMIR has changed over these years.
And I suppose, what's interesting about that review process is, it has some really big benefits, but also can be maybe has a couple negatives. Benefit being you quickly can review legislation, make any quick adjustments that you need to make that might not be working, but then sometimes as well, what some sources have argued is that, because it can come quite quickly and you have a lot of delayed provisions as part of EMIR, which may not take, or other legislation which may not take come into effect for a year, 2 years, while other provisions are immediately implemented or very quickly implemented, it can sometimes take longer to see how the legislation as a whole works together before you can perhaps make an assessment of different provisions. So there's benefits and there can be drawbacks, but overall quite a dynamic system which is changeable. And ESMA, I think ESMA is one example of how the European sort of joint capital market is envisions to work, where you have one sort of regulator which helps supervise all the jurisdictions. I mean, how do they how do they sort of fit into this when you have, the national competent authorities that also have their own responsibilities? Because there were some, remember during our reporting over the past 2 years, there have been discussions as to, how many powers ESMA should have. And some of the national competent authorities said, well, we should have these responsibilities, perhaps, that shouldn't be delegated to ESMA. And then I think there were some compromises, but yeah, what is the role of ESMA there?
Yeah, so ESMA is also the result of the intention, let's say, after the 2008 crisis to improve and also strengthen the framework and also standardize, as we mentioned before, the rules across the European Union, so that all the participants across the EU have to respect the same standards, the same rules, no matter about the location. So I could just mention a few main functions that ESMA has. So one is to ensure the supervisory convergence and the level playing field. So I just mentioned all the participants must respect the same rules. And another important function is that it assesses the risk of the financial system and also evaluates the market development to make sure that these market developments do not make any harm to financial stability. Regarding national supervisory authorities, well, they are in charge of supervising the individual entities, while the ESAs, the European supervisory authorities, among which ESMA, work instead of the harmonization of the financial supervision of the EU by developing, for instance, what we usually call a single rule book, and they promote the application of the single rule book to create a level playing field. And also ESMA is also responsible for the supervision of critical benchmarks and other areas like data service providers and as already underlined before, the systemically important third country CCPs. So there are perhaps a bit differences between NCAs or national supervisory authorities and ESMA, but I would say that they also cooperate very fruitfully together. After all, what matters, at least for us, for CCPs, is that financial stability is maintained and that all the authorities, whether the national supervisory authorities and ESMA, really cooperate efficiently to maintain it. And indeed, an area where they cooperate is, for instance, the stress test. There is just one that is ongoing at the moment. You also mentioned contrasts. I understand that might be contrasts between the authorities regarding powers. I am personally agnostic on who supervises what, but I say what really matters is that a robust risk management from CCPs and robust financial stability is maintained.
Thanks, Elena. And so basically, altogether, we have, the aims of creating cohesive capital markets, financial institutions being able to talk to each other, trying to maximize competition. And a big part of that dynamic, which has changed over the years of regulations, allowing it, not allowing it, et cetera, has been sort of, the interoperability and the horizontal versus the vertical model. And Sebastian, I wanted to very quickly ask you, what are some examples of that work, of those two models working, and how that sort of has an impact on the market infrastructure, landscape, services that are offered, etc.
Thank you, Costas. That's indeed a good question, and to understand how the market infrastructures can work out their strategy in the EU and globally. What we see is that there are fundamentally two types of models. So you mentioned them, the horizontal model and the vertical model. The horizontal model would be a model where a group of companies or a company is concentrating on one layer of the capital markets. So this one, well, typically would be Euroclear, the company I'm working for, which specializes in the central securities depository business, settlement and custody, where we have all our activity there. So we have 6 domestic CSDs, 1 international CSD, and that's about it. We are specializing in this, so that's horizontal. You have the other model, which is vertical, and that's where the groups or the companies want to integrate the different layers within one group, and that's integrating within the group the trading, the clearing, and the settlement activity. So you have the typical one, which everyone knows, is a Deutsche Börse. That's the typical what they are doing, because they have the stock exchange in Frankfurt, they have Eurex, the clearing house, and they have the Clearstream, for example, the Deutsche Börse CSD. So that's 2 different types of model. I will not say here what is the best one. They both have pros and cons. Definitely the European authorities are looking at them quite closely. Fair to say that in the past years, the attention has been less focused on that because what we see through integrations, that it's more and more a vertical model that is being at stake. So what we think from a horizontal model point of view is that obviously there are some cons to this model that should need to be looked at. And the key one is the competitive dynamics in there, because CSDR, for example, I mentioned that it's important competitive dynamics in there. An issuer in Europe has the possibility to choose his stock exchange, to choose where he wants to have the securities listed, to have the securities cleared and the securities settled. So an issuer that is based in France can decide to have securities issued in Euronext Paris, to have them cleared in Eurex Frankfurt, and to have them settled in Monte Titoli, for example. That's the Italian CSD. But that's fully possible when you have a horizontal model with access interoperability between all these different market infrastructure. The risk with the vertical model is that you have captive markets where the access and the interoperability is not as open as it should be, because these groups might favor their own model, so their own stock exchange, clearinghouse, and CSD. So that's something that is being addressed in CSDR through the open access and interoperability requirements. But fair to say, just like I mentioned, it is not the key focus of EU authorities, unfortunately, over the last years.
Interesting, thanks, Sebastian. And so we have these joint regulations, we have this vertical versus horizontal model system. And in that context, we've had a lot of M&A recently. Certainly a lot of competition, but between entities, but there's also this view that you need to acquire to be able to scale up and offer a better value proposition to shareholders. So Laurent, I wanted to very quickly ask you, what has been driving that M&A recently in the context of what the sort of incentives are and who is rewarded in this framework? And has it been more sort of obviously market drivers, low interest rates, etc., more ability to take on debt and go on acquisitions, or has it been driven by other competitive factors that are more sort of unique to the European framework that we might be seeing now?
Sure, thank you, Kostas, and 2 minutes to go to answer this very interesting topic. Well, for sure, I mean, we have seen a decade of regulatory framework to be transposed within market infrastructure. And I mean, it was quite heavy for those infrastructures to digest and transpose those regulations internally. So basically, it's an impact on the cost and impact also on the margin of those institutions, which more than ever, and at the age of this digital transformation that we see also in industry, have to basically develop new business. And this is one of the reason why we see today quite a lot of M&A activities, where those legacy market infrastructure are looking to work together with new fintech company to develop new solution, new digital solution, also to develop new services or expand some services. I think we have seen last week, and Sebastian will agree that Euroclear developed its positioning in the investment fund services. But also the third way in these activities is to consolidate the business together. Euronext was very active in that regard with some key acquisition in the north, but also in the south, and we have also the discussion between Spain and Switzerland right now. So a quite busy landscape right now with new trends, new activities, which is promising for the future of this industry.
Sebastian, do you want 30 seconds? Your firm was mentioned. Do you want 30 seconds to add something to that, or not?
No, well, in 30 seconds, let's say just that we are indeed very enthusiastic about this acquisition, and because in complement to our fund settle activity, it will just bring Euroclear further in the fund business and in the European and global fund landscape. So very positive about this acquisition indeed.
Okay, well, I'd like to thank my panelists for helping us explore the European regulatory landscape for market infrastructure, and also our audience for attending. And yeah, have a great day. Thanks a lot.
Thank you very much.
Thank you very much.